Hello, hi. In this live session, we will discuss about all the recessions in the US in the last century, since 1920s, the Great Depression, and we will talk about all the depressions, all the recessions that happened in this period of 100 years. There have been some really big ones. But there are also some, relatively smaller ones, and we will take a look at all of them. And it's very important at the moment because it seems that recession is looming. Many are predicting that we're going to be having a recession in the near future. So we will try to understand what is recession first of all, and then what really happened to the economy in the previous recessions that we have had in the past. And I've taken the example of the US because US being the biggest economy in the world, it's important to understand the impact on that particular economy, and maybe that can well be the same analogy can be taken to other countries and understood from that point of view, but it could be different actually for other countries, right? But US and Europe in particular are the ones where we have the enough data to actually analyze the recessions in the history in the past. We probably do not have enough data for instance, for the emerging economies. All right, so let's get into it. Before we talk about the different recessions in the US, starting with the Great Depression of 2019. We'll first understand what is recession. Actually, it's a very basic definition, but it's often misunderstood. In the Europe, actually, it's known as, if they have two consecutive negative or zero GDP growth, it is called as a recession. But that's actually not the definition in the US. So that's quite interesting. In the US, it's a bit different, and it's bit more, subjective type, right? Less objective, less specific, so to say. So in the US, it is defined as significant decline in the economic activities in the market, which should last at least a few months, and that impact should be visible in the real GDP, in the income, unemployment rate, industrial productions, wholesale and retail sales. Okay. So there is a bit of a difference between the definition of recession in the US to that of the Europe, but it's recession is nothing but a significant decline in the economy, and you could take any economic indicator. It could be GDP, unemployment rate, or it could be also other economic factors such as real income, industrial production, and so on and so forth. So in the US, actually, more number of macroeconomic variables are used to understand whether there is a recession or not, whereas in the Europe, it's mostly the GDP growth. Okay, and we'll focus more on the US side. So we will not just talk about the GDP. We will also talk about other macroeconomic indicators such as unemployment rate, stock market, real income, industrial productions, things more than GDP. Okay, because the context is the US, so we're talking only about the US here. So we will take the US definition of recession and discuss. So the first one in the 1920s that started in 1929 and it continued for a long time actually. It's called Great Depression, but it is also called the Recession of 1929, and very famously known as Great Depression. It started after a huge fall in the stock prices at around 1929, to be exact, September of 1929. For a variety of reasons, actually, the stock market fell, and there's a huge, fall in the stock prices on 29th of October 1929, also known as the Black Tuesday. So the recession actually started in the September of 1919, and it was huge. Actually, it had a worldwide impact, not seen in the first year, but back in those days, world was less globalized, actually, unlike today, where we are so interconnected. The world is so globalized. Anything happening in the US, will have a significant impact in Europe, in Asia, in Africa, and in all these places. Whereas back in those days, 100 years back, in 1920s, things were different, and there was a lag impact. There was not an immediate impact in elsewhere, but there was a huge impact in the US in the last quarter of 1929. Started with September, but it prolonged for a very long time, and we'll discuss more about it in the subsequent slides. It's by far the biggest or the longest recession in the US history so far. The US hasn't seen a bigger recession ever since. Even the 2008 financial crisis is not as big a recession as the Great Depression by all indicators. And it's also the longest one. It persisted for a very, very long time. I think around about 10 years. So by an estimate, it was thought that in the world's GDP fell by about 15% in first 2-3 years. That's massive, actually. So there was a negative GDP growth of 15% for the world by 1932, and in the US alone, the unemployment rate was at all-time high, 23%. I think that's the biggest. Even during the COVID-19, the US unemployment rate wasn't about 23%. I think I may be wrong, but I need to check that. But I think it was still less than that. So it was that big. There are many good documentaries on Great Depression on YouTube if you want to know more about it and how it happened, what was what exactly was the impact. There are a lot of good documentaries on different YouTube channels. But we will talk more on the economic side. There are obviously some political side to it, right? Every economic event has some political side to it. Either it is because of, such as natural calamities, such as the COVID-19, right? Well, some might argue it was also because of political reasons. The lockdowns were not needed, some might argue that. But, there was this pandemic thing because of which it happened, right? And, but the other recession in the last century were all related to some form of government decisions. Banks were involved, for example, in 2008. Government was also involved in many ways. Central bank was also involved in the US. So there are many political aspects to recessions, actually, but we will not get into those more political aspects as to why the government did not do enough to have checks and balances, did not do enough to avoid recessions, actually. So we will not get into those things, but we will try to understand actually what are the causes of the recessions, impact on the general economy, and you will see actually some of the patterns, actually, right? So most of the recessions are either because of inflation or a massive financial crisis, like the huge increase in default rate, or in some countries, or some big countries defaulting on the loan. So war is also another reason, right? Whether it's recently the Russian and Ukraine war, or in the past the Korean War, the Vietnam War, Second World War. So wars also responsible for reasons for recessions. Inflation, big way. Monetary policy is also a reason for recession in many times. It's bit dispute actually whether what economic policy should be adopted during recession, or what economic policy are responsible for for a recession is a bit of a dispute. It depends, and I will talk a bit about the Great Depression from a Keynesian point of view, from a monetarist point of view. So there are different schools of thoughts, and we'll discuss more about it, especially for this particular one, the Great Depression. But yeah, this photograph, as you see on the screen, is a very famous one. Every time we talk about the Great Depression of 1920s, this photograph is iconic one, where people didn't have enough food to eat. Many people are on the street. Unemployment rate was all-time high in the US. Industrial production was very, very low, and many workers were laid off. And people were used to be given handouts. These things normally is done in more poor countries, but during this recession, actually, people were given free food, free groceries and all by the government, because there's simply not in many jobs in the US. As you can see, some of the statistics we have is that the industrial production fell by an insanely, like, more than 40%. So was wholesale prices, foreign trade, and so on and so forth. Not just in the US, but also in other big economies in those days, such as United Kingdom and France and Germany. So there was a hoping increase in the unemployment rate. We were talking about the regions and the school of thought. There is a school of thought called Keynesian. So it's more inspired by the great economists, the teachings of the great economist John Maynard Keynes from the UK. So the Keynesians, so the people who actually believe in his theories, and people who actually are inspired by his theory of macroeconomy. So according to them, it's the Great Recession happened because of the large-scale loss of confidence. So people lost the confidence in the stock market, in the general economy, actually. Because of which there was a sudden reduction in the consumption and investment spending. People thought that holding money is actually more valuable than investing in the economy, or investing, both the retail investor as well as the more the business people. So business people didn't want to invest money in industrial production because they were not very optimistic about the economy. Investors were investing in the stock market. They were also not very optimistic about the economy, so they instead wanted to hold the money. So there was a huge drop in the demand. So the Keynesian school of thought explains that the Great Depression happened because of the huge drop in the demand for goods and services, but that is disputed by the monetarist. So monetarist is a different school of thought for macroeconomic related matters. So monetarists believe that the Great Depression started as it started as a ordinary recession, like any other recession. Recessions could also happen without a very strong reason sometimes, but it could end up as an ordinary recession not all recession will prolong for a very long time. But the Great Depression actually was very long one. So the monetarists believe that the Great Depression started as an ordinary one, a small one, but because of the shrinking of the money supply, so the Federal Reserve, the central bank of the US, actually adopted the monetary policy to ensure that the money supply is shortened, it is reduced. So that exasperated the economic situation. So that created a mess. So that was the explanation, that it is not a demand side, it is more of a policy related decision. It was a man-made recession. Like the people who are responsible for monetary policy, they messed up all the situation. It was a recession that was rather ordinary initially, but it descended into a Great Depression thanks to the policies adopted by the government and the central bank at that point in time. So that's an explanation, but it is still a dispute as to what really caused the recession. There are many political angles to it also. You can also understood from the point of end of First World War, and because after First World War there was a huge massive economic growth, and every time there is massive economic growth there is an increase in inflation. It stops at some point. It's more of a normal business cycle. So sometimes recessions are inevitable. It will happen after a prolonged economic growth. If it happens for a decade, then the economy could end up being in the recession phase for a while. But why it was so long is a big question. Still a big question. Actually, nobody really understand it properly as to why it was so long. It was not unexpected that it would happen for a year or two, but nobody expected that to prolong for a decade. There are different explanations, but okay, these are the two main ones I wanted to discuss. More impact on the US economy. You see the US debt as a percentage of GDP for the last 100 years, and you see the spike during the 1930s. Actually, there is a massive spike, right? And over these years, actually, it has also increased. For instance, recently it is also quite high. You see, after 2010, also it is quite high. But we are in a different time, so that's still fine. But the spike that you see, the debt as a percentage of GDP was massive during 1930s, and this graph actually tells a lot, actually, right? Even now, the US economy, if you analyze the US economy, the debt to GDP ratio is insanely high, right? Now, whether that is correlated with some sort of a recession or not is a question mark, actually. It's actually other way around sometimes, but yeah, we are also in the phase where we're talking about a very prolonged recession. So only time will tell whether that will prolong or not, but it is quite clear that we're going to be entering a recession in the near future because of the inflation right now, right? And we'll come to that about the more recent recession. But I see a similarity between the one that happened in 1929 to what is happening right now. You see a huge spike in the debt to GDP ratio also in the US. It was also similar in 1929. Worldwide impact. There was impact in almost all countries in the world, but back in those days, as I mentioned initially, that we were less globalized. Now we are a lot more globalized. So an impact in the US will have impact everywhere in the world. But even then, even though the world was less connected, less globalized back in those days, you still see an impact in almost all major economies, especially the major European economies such as the United Kingdom, the Belgium, the France, and Argentina, Germany, or Italy. there was a massive increase in the unemployment rate. There's a huge decline in the GDP growth. Per capita income also decreased. So this is the graph of per capita income. You see a massive drop. In the United States, obviously, it was the highest. You see the top one is the US, where the drop was the massive. That was the biggest impact. But even in other countries, it was still quite prominent. Quite prominent. Yeah. Then the next recession took place in 1945, right after the Second World War. In a way, the Second World War actually helped. Well, we cannot say it's helped, but it somehow helped indirectly to get out of the Great Recession. There was a lot of government spending during the war, so a lot of people were employed in war-related activities in the US particularly, but also elsewhere in the world, in the Europe as well, because the Second World War was centered in the Europe. So a lot of people were involved in the war-related activities, and that actually helped the economy to grow. So the 5-6 years of time from 1939 to 1945, that period was in a way a good time for economic growth. But after it ended in 1945, there was a brief period of recession actually, and it is the end of the War Recession, also known as the end of the War Recession. And it happened because of decline in the government spending. The government did not spend money after that because there was end of the war. Many people lost jobs because the war was over. They were working on war-related activities. They were out of work. That really created the recession. There was a huge, massive drop in the GDP back then. So there was two small recession in 1940s. One was in 1945, right after the Second World War, and then there was one in 1949. So there were two small recessions. But these two recessions were not as big as the Great Recession of 1929, but nevertheless recessions. And I know we discussed initially about the reasons why recessions happen. Well, sometimes it could happen because of natural calamities such as the coronavirus one, but most of the time, almost all the times, these are more man-made. Human beings are responsible for that, whether it's because of war, because of government policies, sometimes also because of mostly war and government policy, I would say. There are other political angle to it also, some because of change in the government, or like in the 90s the recession took place in some of the countries because of political uncertainties and Cold War and so on and so forth, again related to politics, mostly man-made recessions. Even the recent one we were talking about, the 2022 recession, or maybe it will be starting in 2023, nobody knows, but it is quite likely that we're going to be entering a recession. That is partly because of political reasons, right? The Ukraine and US, the Ukraine war is also a reason for that, and no doubt coronavirus actually started it. And after the pandemic was sort of over after 2 years, the inflation rate increased massively because of supply side constraints. So so that could also be reason, but it could be also a mix of both, man-made as well as more natural reasons. So this is the one, but most of the times it's man-made. Then the recession of 1949. So it happened after the Second World War. Again, a similar type as that of the 1945, and you can see the graph here. There were two the 1945 there was massive. So the entire from 45 to 50 there was decline in the GDP in that period. Yeah, then 1953. So 1951 to 53 there was Korean War, the war between the North Korea and South Korea, and US was quite heavily involved. So because of the war related activity there was an inflationary period after that, and inflation was quite high. So there were the economic policies, the monetary policy was quite strict actually. So the interest rates were increased to have control over the inflation, and that really caused a lot of harm to the economy. And the US entered the recession in the 1953. Right, it's also a similar situation right now. Right, we are having a sort of a post pandemic inflationary situation, and the governments all over the world are trying to have control over it, and because of which the interests are being increased. It has already been increased in the US and in the European economies, and that will cause a lot of issues actually. Especially lending will be very tough. There will be a shortage of money, there will be shortage of industrial activities, and that will lead to recession. But normally it actually it's a cycle actually. It starts, and then because obviously the policies are the strict monetary policies are directed towards controlling the inflation, and it takes a while to control. So it's a bit of a cycle. So it will get better. There will be a peak of the inflation, and then it will start becoming downwards, and then it will be under control, and then economy will be on the track. But how long that will happen is a big question mark. In most of the recession last century, it has been for at least a year or so, and to 1 to 3 years, except the Great Recession of 1920s, which prolonged for a decade. Some people have been saying that the one that we are experiencing right now, and the one that will probably happen, will sustain for more than 10 years. Nobody knows, but time will tell. Well, that will be the case. Then there was a recession in 1950s and recession of 1960 and 61. So there was, again, small, very short recession in the 1950s, late 1950s. It started because of the economic downturn of 1950s. It had a worldwide impact. Post-war again. So the thing is with the war is that when it is happening, there is economic growth because a lot of people get employment in war related activities. The moment it stops, then you will have inflations being very high, unemployment rate being very high because government spending has dropped, and a lot of people are unemployed, and so the consequence of war is that post-war it is a problem. And government policies are even more problematic after that, because government policy will be more strict, like the monetary policy in particular will be more strict, and that will be problem, right? Because if the interest rates are very high, then economic activities will decline, because people won't be able to get easy credit. Especially the corporations will have trouble getting money from the bank. Higher interest rates, so they will probably be less motivated to borrow money to spend on economic activity. So that will further reduce the employment. So so it has a bit of a trickle down effect. Then the next recession. So there was then a long period of economic growth. 1960s were very, very good. Actually, there was a bit of a recession in the first part, 1960s, but for more than 10 years, in fact, there was a steady growth of the US GDP, and there was very good growth in the 1960s. But 1970, early part of 1970, then the U.S. economy entered into the recession, 1973 to 1975, and that was an interesting recession. It involved stagflation, which is it's a mix of inflation and unemployment rate. So inflation is high, also the unemployment rate is high. Something that is happening right now also. Not right now. I don't think unemployment rate is that big right now, but it has happened in the past also, where inflation is high. But normally, what happens is that if there is huge inflation, the unemployment rate need not be very high. It is high actually sometimes, but need not be also high. Right? But that was very different in 1973, where it was more of a stagflation, where high employment rate and high unemployment rate and high inflation. Okay. Now, again, what's the reason? There was no proper reason behind it actually. As I told you in the past also, right? We have already discussed this, which is that every time there is a prolonged period of economic growth, the economy will eventually enter the recession at some point. It has never happened in the past in any country that there is a huge increase in the economic activity for a very long time without any recession. That will never happen. Impossible to happen. It has never happened anywhere in the world, and definitely not a very big economy such as the US. So there was a huge increase, huge growth in the 60s, and it was quite expected that in the 70s US will enter the recession, and that really happened. It was also partly caused by the oil crisis back then and the Vietnam War. So Vietnam War also is responsible, but regardless of the war, I think there was it was quite expected that sometime in the 70s there will be recession because of there is a business cycle, right? Every decade or so you enter the recession for some time. That's quite natural, but what is expected is that in a year or 2 years time the economy will recover to the its normal steady growth. If it doesn't happen, that's a serious issue then. And the unemployment rate was actually third highest in the last 100 years, actually, right after Great Depression and the COVID-19 recession. So COVID-19 recession at that point in time, it was second highest, Great Depression highest, and the third highest is this particular recession. Then 70s were again very good years for the US economy. The economy grew very fast in those years. But there was a brief period in 1980s where there were a couple of recessions in 1980s, especially the one that is noteworthy is the recession of 1981 to 82. It happened because of the Iranian revolution. So oil was the reason, energy crisis, oil crisis was the reason. It was worldwide actually, it wasn't just the US. So because of the oil crisis, the inflation increased because right now it's also happening in the Ukraine war. The oil prices are skyrocketing, and because of which everything is more expensive, right? Goods and services are expensive because you depend on oil for a variety of things, right? Transportation, to run your factories, and to do lot of other things. That will obviously cause the cost of production, cost of transportation, cost of doing everything like agriculture even is high, because of which the inflation, the prices are higher and the inflation is higher, right? So, and that will lead to some sort of recession. That exactly happened in 1981-82. Very similar to the situation right now. The tight monetary policy to curb inflation actually caused even more harm that time. Then the early 90s recessions. 90s were again very interesting times for the US economy, because in the 80s there were not many recessions, not many bad years, except the 1980 to 81. and 90s were also quite good. But early 90s there was a brief period of recession because of restrictive monetary policy. There were some tax reforms, again man-made reasons. Tax reforms were also, so the investment was less attractive back in those days because of tax reforms. I think it was Bush administration back then, the senior Bush, I guess, or Clinton administration, I think. Okay, not sure, but so the investment was less attractive, and there was a huge losses in the construction and the manufacturing industry, a huge job losses. So that was a period where early 90s, 91, 92. It was also a time during the Cold War with the Soviet Union. Okay, so maybe that has also some impact in having this sort of recession. But 90s were again quite good years for the US economy until 2000, when the next big recession happened. It started with the dot-com internet boom, that period, and the dot-com crisis started in 2000, and then in 2001 the terrorist attacks, the 9/11 happened, right? So that period was again a very bad time for the US economy, especially for 2 years. And then there was many good years until 2008, when the financial crisis happened. And I think from 2008 US economy hasn't really grown very fast ever since, from 2008 onwards. So it's been 14 years now. But the 80s and the 90s until 2008, except the period for 2000 and 2001, other years were pretty good for the US economy, especially 30 years. Not so much for the the European economy, actually, for a very long time. Not so much for the Japanese economy, or economies of many other countries. But for the US, enjoyed the growth period for a good 30 years, from 1980s to 2008. Then the next recession happened in early 2000. It started with the dot-com bubble. Dot-com bubble is a very famous one. A lot of internet was a big thing back then in the mid 90s. So there was a lot of hype around internet, I think for good reasons. So a lot of people were expecting the internet will change the world, the way we do banking transactions, the way we shop. A lot of companies such as Amazon, PayPal were created back in those days. So a lot of money were invested, private money, the venture capital money, and many of these companies went for IPOs also. So even the the normal public, retail investor invested money in these IPOs without understanding, whether this company will ever make money or not, whether PayPal or Amazon or eBay will ever make money or not. So eventually they realized at some point that these stocks are overvalued, and because of which because the stock market crashed in 2000, a lot of people lost money. Many companies were shut down because there was no business. So that hype did not last very long. It was also because of the boom of 1990s, right? 1990s were very, very good years for the US economy, and because there was a big boom, the 90s, burst was about to happen, and that happened in 2000. And there was also another, unfortunate event that happened in 2001. 9/11 happened, so that is again a reason for a bit of a prolonged period of recession, from early 2000 to end of 2001, even until 2002. So it continued for about 2 years, but it bounced back in 2002 until 2008. Everything was okay, and in fact they were all good years, especially in many areas of the economies, real estate and financing and so on and so forth. Then the Great Recession, it's also known as the financial crisis of 2007 and 8. It happened for it continued for 2 years, but its impact, it's still seen in the economy, especially in the banking and financial world. So I remember I actually started my career in 2008. Just before I joined a company, a month back, Lehman Brothers crashed and collapsed, and it went bankrupt. And we were seeing news channels, and there was footage about how people are panicking. In a couple of months' time, a lot of people are protesting all over the world about the impact on the more general economy. It started in the banking sector, but the recession spread to more general economy, and it was a massive mess that time. So people of my generation will remember that. So it started with the easy credit during the 2000. There was a boom period 90s and 2000. So a lot of people were given credit, although they were not credit worthy, so they didn't have the worthiness to get a loan, but bank were just lending them, especially to buy houses. And because of these more complex financial products, a lot of this, the more mortgages were, the contracts were, they were put into, they were put into, sort of a combined financial package and sold to some third parties, and the third party has no clue the risk associated with this financial products, because they don't actually evaluate. These third parties do not never really evaluate the financial credit worthiness of the clients, the people who have been lent money, who are in some way subprime, like they're not the prime customers, they are not credit worthy, and that risk assessment hasn't been done by the third party, and they were like buying. And when I'm talking about third party, these are actually credit institutions, financial institutions like Fannie Mae and Freddie Mac and all these companies. So it started with the housing bubble, and a lot of people refinanced their houses, and valuations dropped massively. It started with that, and a lot of money were lost, especially the Fannie Mae and Freddie Mac, and Lehman Brothers was also quite heavily involved. It went bankrupt, in fact. So demand of mortgage related security, it started with mortgage, and then it went to the more secondary market, and you can see the subprime mortgage origination. There's a massive increase in the 2000 in about 8 years, and there was a massive drop after 2007, right? So that period really was a big mess, right? Just in 2002 to 2006, there were 5-6 years. And see the mortgage delinquencies during 2008, right? It was like 40%, insane, right? In the subprime sector, it was 40% delinquency. Anyone working in the financial industry would be very surprised with that, but that really happened. And that's because of the regulations are more stricter nowadays. So this is the US residential and non-residential investment relative to GDP. So here you see there's a huge decline. So residential investment dropped massively in that period. Nobody wanted to buy houses anymore. And here you see the private sector financial suffers massive decline. There was a huge decline in the business investment. Many companies went bankrupt. Not just the financial sector, it actually spread to the more general sector as well after a while. So even manufacturing companies were bankrupt. Many auto companies, many manufacturing companies went bankrupt. Many companies didn't have credit to do business activities. They were not getting short-term credit and all that. So that was a big mess. Then the next recession happened in 2020 actually. It's called COVID-19 recession because COVID-19 started in 2019 in the China, but the real impact was shown in 2020. 2020. I think we all know what happened, so I'm not going to spend much time on this, but just a few maybe economic indicators to see actually what really happened. It happened in February 2020. Started in China. Nobody was expecting it will spread to other parts of the world so fast, but I think in a month time things were very different in other parts of the world. Corona cases were found in almost all countries in the world. Many countries went into lockdown, and that because of which there was a stock market crash. So stock market was heavily impacted in March of 2020, but there was a rally actually. It did remarkably well after that, but for a very short period, about for a month or so. I think not a month, for a couple of weeks. I think it really crashed. Perhaps the biggest crash in the last 50-60 years in all economies, by the way, not just in the US but also in Asia and in Europe. And there will be massive increase in unemployment because of lockdowns and people are not allowed to go out and so on. And some sectors were very, very affected. For example, tourism, hospitality, aviations, and these industries. So the unemployment rate in, for instance, the aviation industry was like more than 50, 60%, 70%. So here is the Dow Jones. You see the massive drop in March, but then there was a rally after that. So the stock market really improved after that. And here is the impact on other stock markets, right? I think almost all stock market, whether it's Nasdaq, whether it's stock market Singapore or Europe or Netherlands, in Hong Kong, India, there was a massive drop. But things changed for stock market, but not so much for the general economy actually because of the lockdowns. I think it took about a couple of quarters. So 2020 is definitely a recession year, but it changed. 2021 wasn't because there was a vaccine actually. There was a vaccine so vaccine changed everything actually in 2021. So because of the vaccination, and it happened, the vaccinations played a big role because of the vaccine, people were allowed to go out and industrial activities started. Production increased, aviation, tourism, and other sectors also were, started after that. So I think things changed a lot after that. So, but I think we are now dealing with other things. For instance, we are dealing with the Ukraine war, oil crisis, the inflation, which is more supply side driven. So we are dealing with that at the moment, and we are not yet in recession, by the way. The US is not yet in the recession, technically, but it might well be in the recession in a couple of months' time. That's what is being predicted. Probably by the end of 2020, the US will enter the recession. That is something people are expecting. I think in 2023 will be a challenging one for sure. Yeah, if not a recession, maybe a very bad years for sure.